Our next guest says mismanagement of the pandemic in Europe has led to governments taking costly measures that could cause a lasting impact to jobs, personal health, and the economy. Joining us now is Daniel Lacalle, who's just authored an article on the subject for Hedgeye. He's the chief economist at Tressis as well. Daniel, let me first ask you what you think of the optimism in today's market. And really, we've seen a pretty decent risk asset rally over the last few weeks. It seems investors feel like this is it. We're past the first wave and we're going to get back to business as usual and rebound in the economy in the second half.
I thank you very much. Yes, good morning. I think it is right. I think that investors are sort of considering 2020 as a lost year and starting to think about what is going to deliver in terms of economic growth and earnings for 2021. I think that at the same time, the news about a possible vaccine and a possible beginning of a gradual recovery of the activity in most economies is making people a little bit more optimistic. I think in any case, we need to be extremely cautious. We already fell to excessive optimism at the beginning of January when the news in China was starting to unravel. And we think that these rallies in equity markets should be used to sell some of the more cyclical exposure and to be prudently exposed to equities, but less so in inflationary, in the assets that are more exposed to inflation and to economic growth.
Let me ask you, Daniel, about what we're relying on in Europe to pull us out of the crisis. And there's a role for banks here. Many people have said, whilst banks were part of the problem back in the financial crisis, maybe they can be part of the solution here. But are we expecting too much from the banking sector in terms of its ability to continue the flow of credit to businesses that are struggling?
Yes, Anna, you're absolutely right. I think that we're expecting too much from banks. Banks are definitely stronger now than they were in 2008, and they've done an admirable job of strengthening the balance sheet in an environment of low rates and very poor returns. However, what most governments in the Eurozone are doing is relying entirely on the balance sheet of banks and the private sector to leverage and to get more credit in order to pass the period of lockdown and achieve the recovery. I think that is extremely aggressive and very optimistic, but more importantly is that banks are certainly going to be able to address the rising non-performing loans in their existing portfolio and the fall in asset prices. I'm completely sure that they will be able to do that, but banks cannot just double or triple their exposure to risk at much lower rates, which is what some governments in Europe are demanding of them. That could generate further down the line a financial crisis that could be even more problematic than what we are dealing with today.